Hey everyone, it's great to be here today. My name is Eli. I'm an investor at Multicoin, and for the better part of the past 12 months, we've been thinking long and hard about the world of physical collectibles and kind of the tools we use to trade them. A couple months ago, my colleague Vishal and we published a blog post outlining some of our thoughts on physical collectible marketplaces. This presentation is somewhat of a spiritual successor to that blog post. We'll kind of dive deeper into how we're thinking about things. Before we dive in, a quick disclaimer. Please note my comments today are my own personal views and not the views of Multicoin and should not be considered investment, legal, or financial advice. This presentation is not an offer of Multicoin's investment advisory services or an offer to acquire interest in any of Multicoin's managed funds. With that out of the way, let's start with some context on collecting. So collecting is a massive market and a really common behavior. In the US, over 1/3 of Americans are considered collectors, and the market size across all collectible categories, from watches to whiskeys to fine art, is close to $500 billion. So clearly, this is a big thing, and we believe with a pretty high degree of conviction that there are lots of valuable venture-scale businesses to be built around this behavior, specifically marketplaces. I think it's worth getting into a quick history of the evolution of online marketplaces more broadly. The first instantiation of these marketplaces looked a lot like Craigslist, which functioned as digital bulletin boards where buyers and sellers could find each other. After Craigslist came things like eBay, which introduced trust by building tools around transactions between buyers and sellers. So previously, marketplaces were simply venues where buyers and sellers could find each other. Now, eBay and others built tools such as escrow and refunds that kind of built trust around the transaction. And more recently, we've seen things like StockX, which were the first kinds of marketplaces to meaningfully verticalize around a niche. In the case of StockX, it was sneakers and later on streetwear, but there are many others like Chrono24 for watches or Bring a Trailer for used cars. Something that we've noticed across all three of these evolutions of marketplaces has been the emergent behavior of flipping. And we define flipping as someone who buys and sells explicitly for a profit. So the job of a flipper is to find mispriced items, to buy them at a lower price, sell them at a higher price, and they make money off of the spread. If you look at a lot of the collectible marketplaces today, they're really not designed for flippers, a cohort of collector that we believe to be really large and growing. The key problems around this are almost every single marketplace today requires physical settlement, meaning that a transaction closes not only when the seller receives funds in their bank account or their Shopify account credited or whatever, but also when the buyer takes physical delivery, usually via shipment, which can take days to weeks to months, depending on how that thing is shipped. We think that this doesn't make a lot of sense in the internet age, and there are lots of ways to kind of streamline this process using crypto rails. So that kind of begs the question, what would the ideal marketplace look like if it were purpose-built and designed for flippers? We think it would have three key features, the first being instant trading, which we define as the ability for someone to buy something and then instantly turn around and sell it and take profit from the difference. This behavior, number one, lowers inventory risk for flippers, and number two, can dramatically decrease the operating cost for them as well, all leading to lower spreads, better prices, and ultimately more liquid markets. The second key feature here is cash settlement. So like I mentioned earlier, the kind of ideal, if you were redesigning a marketplace, the ideal would be that a buyer can take ownership immediately, the seller can get funds instantly, all before anyone takes physical delivery of the item. And this is really only possible with the third feature, which is trust around custody and authentication. This means that both parties need to know that the item that they're buying and selling is real, safely stored somewhere, authentic, all before the purchase is finalized. And if we look at these three kind of features, there is no existing marketplace today that serves all three of them. I think basically every single marketplace that you or I have used, they're all physically settled. The vast majority of them use fiat, which can be slow, expensive, and cross-border payments sometimes impossible. And not all marketplaces, even today, offer guarantees around authentication and fraud. So in this light, we propose a new solution, a new kind of marketplace built on crypto rails. We see this as an opportunity to redesign a marketplace from first principles that is purpose-built for traders and flippers. We call these blockchain-enabled collectible marketplaces, or BECMs. And kind of to reiterate, the three characteristics here are number one, fast global payments via stablecoins. Number two, all of the assets are held and authenticated by a trusted third-party custodian. And number three, all of the items in the marketplace are represented and traded as NFTs to enable that instant trading. And the cumulative effect of these three characteristics should be that a trader anywhere in the world can transact with anyone else in the world with strong guarantees around fraud, authenticity, and safe storage. And you can probably create a Beckham or blockchain-enabled collectible marketplace for any type of collectible, but we want it to be more precise and rigorous as investors. And our job is to kind of spend time thinking about where the most lucrative and most venture scale opportunities are. And in this light, not all collectible marketplaces are created equal. There are lots of nuances around the market structure for each of them. And throughout our conversations with entrepreneurs, with collectors, with dealers, and flippers, we've kind of come up with 7 characteristics that we use internally to evaluate these opportunities. So that's what the remainder of this presentation will be about, just diving into the 7 factors listed above. The first set of factors that we look at kind of relate to the financial aspect of a collectible. The first being, what do existing trading venues look like? So the marginal value of a new marketplace is really dependent on what the status quo is. Most collectibles do not have a dedicated exchange or marketplace that they trade on. For example, there's no like NASDAQ or Coinbase for handbags. Instead, a lot of these collectibles trade across disparate venues like group chats or WhatsApp groups or Discord groups or even auction houses or a longer tail of online marketplaces. I think at a high level, the way we think about it is that the worse the status quo is, the better the opportunity for a Beckham to come in and 10x or 100x that trading experience. The second thing that we look at is the price point. And within the price point, there are kind of 2 aspects or 2 ways to look at it. One is how accessible is this to collectors? And the second is what do the unit economics look like for flippers, or really you can think of flippers as market makers in these markets. On the accessibility side, the collectible should be expensive enough that there's some social status to be gained from collecting it, but cheap enough that the vast majority of people can still outright own the asset, or in an ideal world, own multiple of the asset, so you can form a set and collect. To kind of visualize this, I think examples at the extreme, Ferraris or classic cars, for instance, probably price out the vast majority of the world's population, and it's going to be hard to find and make liquid markets for those. On the cheaper end of the spectrum, you can theoretically or technically collect bottle caps, but they're probably too abundant and too cheap for most people to care about. On the unit economic side, the crux is that when a market is made for a collectible, it requires a flipper to kind of spend time researching to find that mispriced, mispricing in the market. That is only worth it for the flipper if the profit that they can make is worth the time spent. If the price point is too cheap, the absolute value of the spreads that the market maker makes is too small, which either, number one, requires them to bundle up items, reducing liquidity, or forces market makers to turn things over more times. Either way, not a great experience for the collectors. Throughout our thinking, we've kind of contend that the optimal range for a collectible is somewhere between $1,000 and $100,000 US. I recognize that this is not a particularly narrow range and not super useful, so we've also kind of internally made this chart which plots a bunch of different collectibles on a spectrum of price point and venture investability. The final aspect on the financial axis that we look at is the collectible perceived as a store of value? Something becomes perceived as a store of value once enough people believe that it will be culturally or financially relevant far into the future. From a collectibles point of view, there's kind of 2 questions that we ask. The first is this collectible or is this thing relevant across generations? And 2, is it resistant to technological change? I think the best example of a collectible that fulfills both of these and is viewed by many as a store of value is fine art. Fine art, people have been enjoying art for thousands or tens of thousands of years. It's a pretty safe bet, at least in my opinion, that people will continue to do so thousands of years from now. The next 2 factors kind of touch the real world or physical aspect. The first has to do with storage. When we think about storage, the question we ask ourselves is, how hard is it to store this collectible? Collectibles that either take up a lot of space or are environmentally sensitive are typically prime candidates for a blockchain-enabled collectible marketplace. The reason being is the harder it is for a regular person to store a collectible, the greater the value of an outsourced custody solution. On the other hand, if collecting or storing the thing is trivial, number one, it's going to be a lot harder for people, or for you as a marketplace, to convince people to send you their things. And second, it opens the door for a lot of, or a low barrier of entry for competitors to come in and create competing marketplaces. I think a good way to place this in historical context is to look at NFTs, which are probably as easy as they get to store, just given that everything is digital. If you look at NFT market share over the past 4 or 5 years, we've kind of seen a bunch of players come and go, and I don't think a single marketplace has held the dominant spot for more than 18 to 24 months at a time. The second issue, or the second aspect on the physical side, is trust. So similar to storage, if the market today is rampant with fraud, there's a much bigger opportunity for an authenticator to come in and guarantee people trust around transactions. Beyond that, there are a couple of nuances of how a marketplace can implement authentication. The first is obviously outsourcing it, just like send your watch to a watch dealer or get a paint, someone from Sotheby's to come and authenticate your painting. This typically actually works well if authentication itself is a commodity and something easily done. But if it's not, there's an opportunity for marketplaces to build meaningful moats around doing authentication in-house. The final axis that we look at is the emotional one. The first thing that we try to look at is provenance, meaning how does a collectible item get its value? The first way, or kind of first set of collectibles, are brand-based, meaning a collectible is valuable because over time a brand has built prestige, and because of that prestige, the market is willing to pay a significant premium for their products. I think the perfect example of this is luxury watches. A Rolex watch itself, even though it has great craftsmanship, might not be worth $20, $30, $40, $50,000. But the reason many of us are willing to pay that amount is because of the brand that Rolex has built up. In the case of almost all brand-based collectibles, there is a central profit-seeking company that continuously issues new supply of products. This may seem obvious on the surface, but I think there's an interesting implication, which is that it supercharges or encourages secondary market activity. The reason being that when this company or brand issues new product, collectors need capital to purchase that new product. The way they fund those purchases is by turning to the secondary market and selling their existing inventory. That is why we believe that brand-based collectibles are better candidates for these Beckhams because of the flywheel of secondary market activity. All of this is in contrast to time-based collectibles, which get their value from historical context and their age. A good example of this is rare books. There is no company continuously producing rare books. Books were simply produced at some point in time and became valuable or collectible because of the historical context and age associated with them. All brand-based collectibles only trade on secondary markets, but the issue here is that there is no kind of continuous primary issuance of new rare books that forces existing collectors to sell their inventory to purchase new ones. So we think that a lot of brand or time-based collectibles will have artificially constrained secondary market activities because of this. The final factor that we consider when looking at these companies and these businesses is, does a passionate collector base exist? And we define this as, are there forums, group chats, subreddits, where people have heated discussions about which car is better than the other, or what their favorite handbag brand is. We actually think that strong disagreement is a strong positive signal because it means that people care enough about the thing to actually go out and disagree with one another. And the reason that passionate collectors are important is because you need diamond-handed people to form price floors and passionate collectors to form the core of organic liquidity. So I hope you can tell, but we're really excited about the future of collecting, and we truly believe that Beckhams are the future of how people will collect. And we also think that they can meaningfully grow the total size of the pie with respect to collecting by solving some of these 4 problems that have constrained the collector market today. The first way that this can grow the pie and meaningfully expand the market is by eliminating physical custody as a bottleneck. Again, like I mentioned earlier, by outsourcing custody, you are no longer limited by physics to what you can store. For example, if you are a wine collector living in New York City, you may only be able to practically store 50, 75, maybe 100 bottles in a 2-bedroom apartment. If you use a Beckham with outsourced custody, you're now no longer limited by physics, but instead by capital. You can collect as much as you can afford. The second problem that we think will be solved here is around trust and authentication. We think that there is a meaningful cohort of collectors who do not engage as much as they want to in the collecting market because they simply do not have any venues where they trust the other person. For example, if you're a first-time or an inexperienced watch buyer, it is a tough sell to hand over $30,000 via USDT to a stranger on the internet. But this happens every day today. The third way is around unifying markets and liquidity. As I mentioned earlier, many collectibles trade across disparate groups, like dozens of group chats, Discord groups, 3 different auction houses, and 5 different online marketplaces. We think by providing a 10x better experience, we can unify these markets, aggregating buyers and sellers, creating a ultimately better place for everyone. And the final and probably most interesting aspect here is around financializing the behavior of collecting. When you have physical custody of a collectible, it opens the door to create many different interesting financial products. I think one that we're starting to see today is borrow-lend. For many collectibles like watches and whiskey, the dealers of these collectibles, people who make a living off of buying and selling, are cash constrained because most of their capital is tied up in inventory. If I'm a watch dealer, I may only have $10,000 or $20,000 cash on hand, and the rest of my net worth is tied up in my watches. We think that by providing loans backed by collateral sitting in vaults, we can give these dealers liquidity from their collections. If you ask a watch dealer today how they're going to get money, they can't go to Bank of America or their local bank and get a watch collateralized loan. They might be able to go to a pawn shop, but it's going to take triple-digit APRs and usually pretty poor LTVs. We're already seeing some of this borrow-lend happen on the whiskey market at Baxis, for example, a company we recently invested in. So as I hope you can tell, we're really excited about the future of collecting. We made our first bet here in Baxis earlier this year. We was creating a Beckham for whiskey and fine spirits. But we're really interested in speaking with anyone creating Beckhams from handbags to antiques to watches. So if you're building this space, we'd love to hear from you. Thank you.
All right. Thank you so much, Eli. We got some time here for some questions and answers. Anyone have any questions for Eli? No one has any questions. All right, there we go. We got one.
Thanks, Eli. So my question to you is regarding the notion of having qualified custodians. How would you maximize trust assurances between the user of the Beckham and the qualified custodian?
Yeah, I think there are much different ways to do this. The first is to have the marketplace do all of the custody initially. That's what I think a lot of the early Beckhams we're seeing do, like Baxis, for example. They own and operate their own vaults. Watches.io or Kettle or those types of companies that do for watches, they also operate their own vaults, like in their offices. We think the trust assumptions for something like that is roughly equivalent to what you're buying from today. You trust eBay to properly do a refund if something bad happens. So that's one way. Obviously, that doesn't scale very well if everything's kind of sitting in one vault in New Jersey or something like that. Moving forward, or kind of in the farther future, I think there's an opportunity for a distributed network of vaults. For example, in the watch industry, if you're a watch dealer, you could sign up to be a vault. You can take shipments from people. There might be audits, monthly, quarterly, whatever. There could be some staking mechanism. But I think the design space with crypto is pretty open to creating economic incentives for vaults or people that custody these assets to be compliant.
All right, time for just one more question.
Thanks, Eli. Just wanted to get, from your perspective, how important is the ability to fractionalize ownership in these assets when you're looking at investments, or just more broadly as it relates to Beckham's becoming more prevalent in the market?
Yeah, great question. This is something we've debated a lot internally. I think for the initial stages or kind of early companies that we're looking for, fractionalization is actually explicitly against collecting, or like the kind of the ethos of collecting. As a collector, you want to own the whole thing. There's kind of less status or emotional high or dopamine from collecting like a fourth of a painting. But that's not to say like we don't think fractionalization is interesting. I think down the line, when a lot of these assets are custodied and you can create financial products on crypto rails like derivatives or fractional ownership, that becomes a lot more interesting. But I think for now, we're most interested in the behavior of collecting, which kind of implies like owning the whole thing.
All right, and we will do just one more real quick.
Hey Eli, thanks for speaking. So wanted to ask about kind of like the whole product in between each industry. If you're trying to like bring these to market so they're usable, do you have to approach the whole product differently in whiskey or in fine art, or are you trying to like kind of wrap it all into one?
Yeah, great question. So past 6 months, we've spoken to a bunch of different collectors, traders, and dealers across a bunch of different collectible categories. And I think there are meaningful differences in the problems that each face. For example, like people in the watch industry, like being cash-strapped is a legitimate problem. There's a whole informal lending market on 47th Street in New York where dealers literally cross the street with a watch in hand, they give it to a friend, and then the friend gives them $20,000 in cash with kind of the implication that I know you, you know me, I will pay you back in a week. That problem, to our knowledge, doesn't exist as much in like the sneaker trading industry, where people are just very willing to lower the price on their sneakers if they need access to capital immediately. So I think a lot of those nuances should inform like a marketplace's kind of strategy and kind of which cohort of users that they want to target first.
All right, thank you so much. Everyone, let's give Eli a big round of applause.